By the end of this video, you'll know exactly how to find off-market real estate deals before anyone else even knows they're available. And the last method I'm sharing today, most investors don't even know it exists, but it's how the pros are quietly building portfolios while everyone else fights over the same MLS listings. So grab a drink, get comfortable, and let's get into it. First, let's talk about why off-market deals even matter. When a property hits the MLS, it goes through what's called the retail pipeline. That means it gets seen by every buyer, their agent, and typically 3 or 4 other investors, all competing at once. Prices get bid up. Terms get competitive. You end up paying retail price for a wholesale product. That's not investing. That's just buying. Off-market deals bypass all of that. You're dealing directly with the owner. No agent commissions eating into the seller's motivation. No competition, just a private negotiation between two parties. The average investor who masters off-market sourcing can expect to pay 15 to 25% below market value consistently. Over a portfolio of 10 properties, that's hundreds of thousands of dollars kept in your pocket instead of handed to the market. All right, here's the first method: direct owner outreach. This is the easiest place to start. It requires zero relationships, zero reputation, and can start generating leads within 48 hours of you deciding to act. What you're looking for are distressed homeowners, people going through divorce, pre-foreclosure, inherited properties they don't want, estates that need cleanup they can't afford. These are people who need to sell, but the traditional market isn't working for them. Here's what you do. Pull a list of owners in your target neighborhood. Use a service like PropStream or Batch EPS. Filter for equity holders, people who own their homes free and clear or have significant equity. These owners have flexibility. They can sell without a bank involved. That makes them ideal candidates. Then send a simple, handwritten letter. I'm not kidding. Handwritten. Studies show handwritten mail has a response rate 3 to 5 times higher than printed mailers. Keep it short. Introduce yourself. State that you're a local investor looking to buy property. Give them a simple reason to call you back. No pressure. No lengthy explanations. One investor I know of, a woman named Teresa in Phoenix, sent out 200 handwritten letters every month for 6 months. Her response rate was around 2%. That sounds small, but 2% of 200 is 4 qualified leads every single month. She closed 3 off-market deals in her first year that way. Combined, those properties were worth $420,000. She paid $315,000 for all 3. That's $105,000 in equity she negotiated directly into existence. Not from a wholesaler, not from an agent, from a letter she wrote at her kitchen table. Now here's where it gets more powerful. Go beyond mail. Knock on doors. Drive for dollars. This is where you physically drive through neighborhoods and look for properties that show signs of distress: overgrown lawns, boards on windows, mail piling up, property records showing tax delinquencies. In Austin, Texas, a group of investors dubbed themselves the Tax Salad Crew because they pulled tax delinquency lists and targeted those owners specifically. They found a seller who was 3 years behind on property taxes on a home worth $270,000. The tax lien was $18,000. They paid the $18,000 and the owner deeded them the property. $18,000 for property worth nearly $300,000. That's not a deal. That's a life-changing moment sitting in a public record anyone can access. All right, method 2. Building relationships with the people who already know where the deals are. This is where most beginners drop the ball. They think real estate investing is about finding deals. It's not. It's about finding people who find deals, then becoming the person they want to call first. Wholesalers are the biggest one. A wholesaler's entire business model is finding off-market properties and assigning the contract to investors like you for a fee. Typically 2 to 3% of the purchase price, or a flat fee somewhere between $5,000 and $10,000. They do the hunting. You do the buying. The relationship works. But here's the catch. Not all wholesalers are created equal. A bad wholesaler will send you properties that don't match your criteria, deals that don't pencil out. Time wasters. A great wholesaler becomes your unfair advantage. They know what you want. They see a deal that fits. They call you before they call anyone else. How do you find great wholesalers? Start by building rapport. Take them to coffee. Ask them about their business. Understand what markets they cover and what types of properties they typically see. Then be the kind of buyer who closes. Wholesalers lose money every time a deal falls through because the buyer couldn't perform. If you prove you can close quickly, in cash, with flexible timelines, you become the first call. Beyond wholesalers, build relationships with probate attorneys. They handle estates. Estates often need to sell. The heirs don't want the property. They want the cash. A probate attorney in Tampa named Marcus started referring clients to a local investor group after they helped one family liquidate an inherited rental property in under 30 days. That investor group now gets 2 to 3 referrals per quarter just from that one relationship. Zero marketing cost. Pure relationship capital. Talk to divorce attorneys too. When couples split assets, sometimes one party wants to cash out of a house quickly. Banks won't lend fast enough for their timeline. Traditional sales take too long. These attorneys need someone who can close in 2 weeks. Be that person. Also, talk to code enforcement officers. This one sounds strange, but hear me out. Code enforcement knows which properties are being flagged: vacant properties, abandoned buildings, chronic violators. These owners are often elderly, absentee, or dealing with situations that prevent them from maintaining the property. Many of them would sell if someone made it easy. One investor in Detroit built an entire portfolio of 12 vacant lots and distressed rehabs by taking code enforcement officers to lunch once a month. He spent maybe $200 on meals over the course of a year. He acquired over $500,000 in real estate through that alone. If you're finding this helpful so far, hit subscribe. I drop videos like this every week, and the third method is the one that changes everything. Trust me, you don't want to miss it. Okay, the best one. Ready? Technology and specialized networks that most investors don't even know exist. There are platforms built specifically for off-market deal flow. I'm talking about tools like Lead Farm, Off Market, and Hubzu. These platforms aggregate distressed properties, pre-foreclosure listings, and owner-seller communications before properties ever hit the open market. Some operate at the county level, others aggregate nationally. But there's something even more powerful: private investor networks and mastermind groups. These are communities of investors who share deal flow amongst themselves. When one investor in the group finds a deal they can't fund or don't want, they pass it to another member. This creates a closed ecosystem where deals circulate before they ever reach the public. A real estate investing group in Atlanta called themselves the Quiet Buyers Club. They had 47 members at last count. Any property submitted to the group had a 72-hour exclusivity window. Members could make offers during that window. After 72 hours, if no one in the group bought it, it went to the general market. Over 2 years, they estimates they collectively saved over $2 million in acquisition costs compared to buying the same properties on the open market. $2 million, shared across 47 families, all because they built a private deal flow network. One more thing about technology: don't overlook vacancy data. Utilities are cut. Mail stops. The county assessor shows no occupants. This is publicly available information in most jurisdictions. You can cross-reference vacancy records with owner mailing addresses. If the owner lives 3 states away and the property has been vacant for 8 months, that's a motivated seller sitting in plain sight. They bought the property years ago. They forgot about it or can't manage it from a distance. A letter to that owner at their current address explaining you're a local investor can unlock deals that have been invisible for years. Let that sink in for a second. Most investors are fighting over the same 3% of properties that hit the MLS. You're playing in the 97% that never gets that far. That's not a small advantage. That's an entirely different game. So there you have it. 3 real ways to find off-market deals: direct outreach and drive for dollars, relationship building with wholesalers, attorneys, and code enforcement, and technology-powered networks that give you first look at properties before the competition even knows they exist. If you got value from this, share it with someone who's still overpaying for properties on the MLS, and subscribe. I've got something even better coming next week that I think you're going to love.